I get calls all the time from people when they get their insurance bill. They say, "You've got my house insured for $200,000 and my neighbor next door has his for sale for $150,000 and it's been on the market for 6 months. Why don't you reduce my coverage to $150,000? Well, the simple answer is we really can't. There are several factors that determine the insurance value, none of which have to do with the market value of the house. Market value is what a knowing buyer, a knowing seller would reasonably expect to pay for a house in that neighborhood with that square footage. The appraised value is a second term, and the appraised value refers to the amount of money that the bank will loan you or the mortgage company will loan you to buy the house. The third factor is the assessed value, and that's what the tax assessor says the house is worth, and the taxes that you pay on it are based upon the comparable sales in the neighborhood in the tax assessment district. The final thing that the insurance companies look at, I call the insurance value, and that value is determined by the cost of drywall, the cost of 2x4s, shingles, plywood, the cost of the building materials, and the labor involved to rebuild your house stick for stick in the event of a total loss, fire, tornado, explosion, any of those values. And to get the best insurance value, the insurance companies require that you insure the house for 100% of that replacement cost. It's not the market value of the house, it's not the appraised value or the assessed value. It's the insurance value, and that's determined by cost of building materials. And in order to complete that, you have to insure at what the insurance companies say the cost to replace the house is. I hope that clears up things a little bit. Thanks for your time.